The next rider that we'll look at is a term insurance rider. This is where it's useful to understand a little bit about the results of a needs analysis. So let's say that we sat down with a family, we did the needs analysis, and we figured out that they had a need of $1 million, just to use a nice round figure. So we sit down with this family, they say, okay, we figure you need $1 million of insurance. Great. And we look at their situation, and it turns out that they are pretty investment focused. They understand how investments are going to work. They do a regular job of managing their other investments. They like the idea of seeing exactly where their insurance dollars are going. Hopefully you're with me here and you can see that for that client you might recommend a universal life insurance policy. So we look at their situation, $1 million of life insurance, universal life insurance. It might cost them somewhere around maybe $8,000 a year, depending on their age, as a cost of insurance for $1 million universal life policy. Might be a little bit more than that, might be a little bit less than that, but probably not a lot. So $8,000 a year, the client says, whoa, hang on a second. Not incorrectly, that's a lot of money, $8,000 a year. If you've got somebody who makes $80,000 a year, you're going to take 10% of their salary in order to fund this life insurance need. Now, the life insurance need, it's important, it needs to be met. So we want to make sure that we're going to put in place a provision here that's going to allow for them to purchase the appropriate amount of insurance. Now, we saw that Universal Life is the appropriate product for them, but they're not going to buy $1 million of universal life insurance. So how about this? We're going to look at a UL policy, maybe a $400,000 universal life policy, which might reduce their insurance costs down to about $3,500 a year. I know you'll look at that and say, if you're quick at math, you'll say, well, 40% of $8,000, that's $2,400. That will use $3,000 a year. It's a little more than what they should be paying proportionately, but as you purchase less insurance, we go into what's called a lower band, and the cost actually increases. Buying insurance is a lot like buying a lot of other things. The more you buy, the less you pay per unit. And then what we're going to do, because $400,000 is not enough insurance, we're going to add a term rider. They need still $600,000 of insurance. That term rider is going to give them lots of flexibility. Normally, a term rider is sold much the same way as term insurance. It'll be renewable and convertible on either a 10-year or 20-year term. And with that term rider now, you might see their cost on a $600,000 term rider. It might be maybe $1,000 a year per annum or per year. So now, their cost is $4,000, give or take. There's not going to be any policy fee on this term rider because they're already paying a policy fee incorporated into their universal life policy. This is a rider, not a new policy, so it doesn't have any additional expenses associated with it. So we'd say $4,000 a year to get your $1 million of coverage. It's about half what it would have cost you to do the same thing with just universal life insurance. Now, it's not the only type of term rider you'll see. It's also possible to add a child rider and a spousal rider. You'll find all kinds of variations on these ideas when you're out in the industry, but basically what you're going to see is that a child rider normally includes something like $25,000 of life insurance per child under the age of 25. The cost is normally very low, and one of the really great things about these child riders is that normally they are convertible into individual coverage for the child without providing evidence of insurability. The spousal rider is normally somewhere between $100,000 and $200,000 of coverage. It's also normally fairly inexpensive, and it's also normally convertible into an amount of insurance for the spouse. So these are both ways you can add a little bit of insurance onto an existing policy. Because they're riders and not new policies, they don't incorporate a policy factor, so they're quite a bit cheaper than if you were buying, say, $25,000 insurance on a child's life. The last rider we'll look at is the parent's waiver. And the parent waiver allows you to put insurance in place on the life of a child, which I know we talked about a fair bit already. But now we say, what if something happens to the parents and they're no longer able to pay the premiums? You have a child who's 14 years of age, something happens to their parents, the child's not going to take over the premium payments. So if you put a parent waiver in place, if you choose this rider, and something does happen to the parents, typically upon the death or sometimes severe disability of the parents, then the child's premiums will be paid until the child reaches a certain age, sometimes the age of majority, or sometimes until they're done post-secondary schooling. So this is a relatively inexpensive rider and a way to really ensure the fact that there's going to be insurance in place down the road. On that note, we're really done with the riders. It is something you have to understand. You'll find in a fair number of the exam questions, you'll be expected to pick out the appropriate product for a client, and that product will include a choice of riders. Or in some cases, you might just be asked to choose which is the most appropriate or least appropriate rider for a client in a particular scenario. So good luck with the questions associated with riders. You will certainly have to know them, and you'll have to know them later on as well. You will have to know them servicing life insurance products. Enjoy your studies, and the next topic we'll be looking at together will be the application of some life insurance products. Thank you very much.